Hello, welcome to the exciting journey of the first course from Ati, Investment Basics. This is the first module, Introduction to Markets, and in that, the first chapter, Need to Invest. This particular course and the module is going to be at a very basic levels, but you would be really surprised to see how much of basics really helps, and it's good to know the basics if you really want to make a big mark on it. This is the course material. I'm going to be following Zerodha Versity for all these courses, the free courses, and this need to invest module 1, which talks about why should we invest, the where to invest, and then little bit on what are the things to know before you do the investment. We are getting into details anyways, so let's start. Risk disclosure. It's risky to invest. uh, Financial success depends on various factors. We cannot take responsibility for your financial success. Let's talk about why do we invest. Everyone today, all of us are getting bombarded by lots of investment advisors. CNBC is continuously talking about multiple investment vehicles. You have got every other site talking about financial literacy, financial knowledge, investing in the right form, mutual funds. There's so many things. But I mean, as a starter, as a newbie, you always have a question: why should I invest? I mean, I'm earning enough, I'm saving enough. Whatever I'm saving should be good enough for my later years of my life. Uh, the most important thing here to notice or to keep in mind is cash is and depreciating asset. When I say depreciating asset, what you could buy for 100 rupees last year, you will not be able to buy it today. Or today, whatever costs 93 rupees is same thing whatever used to cost 93 rupees last year cost 100 rupees today. So if you save cash, that is the value of that cash is continuously going down. In India, it's between 6 7 8% inflation is what we are living in. Let's look at some numbers. I have talked about beauty of compounding from a different point of view. Now this is from your investment point of view. So let's start with these numbers. Let's say you have got current salary of 50,000. You are a very young graduate, got a very good decent job, and you hope or you wish to get yearly increment of 10% year on year. And let's say the inflation is 8%. And today, between the lifestyle that you have total expenses of, let's say, 30,000. So if you look at this sheet, what it does is, year on year, every row is 1 year. Year on year, you are adding 10% to your salary. So at the end of 30 years, typically, let's say you start your career at 23, 24, and you retire at 60, which is about 34, between 34, 36 years. So I'm calculating only for 30 years. So by the end of 30 years, your salary would be about 95 lakhs. Okay. So if you get 10% increase every year, yearly expenses, 30,000 is about 3,600. And then same way, if you keep on growing it by 8% without changing your lifestyle, so you're probably not going to have increased family, you're not probably have increased liabilities, just the way you are going today. If you continue doing, at the end of 30 years, your cost of living is going to be near about 33 lakh rupees. Okay. And then excess, whatever you save is whatever you save. So first year you save to 2,40,000, next year you save what, 2,70,000, and so on and so forth. And if you really look at the running total of that, it will be something like this. At the end of 30 years, you would have about 5 crores 80 lakh rupees in your bank. Great, very nice, right? But then, if you really look at the cost of living or the expense that you are going to be taking up per annum is 33 lakhs. And if I just simply divide this by 33 lakhs, it comes to about 17 years. So you can only last, your cash will last only for 17 years. So if you, let's say with this, if you retire at 55, you can probably expect yourself to be living with enough cash 70, 72 years of age. With the life expectancy that is going up, do you really want to be at age of 73 where you may not be able to be do a job or earn livelihood and having no cash, being dependent on your children? That probably is not the best of the best things that you want to have. So let's say now, with the same thing, you invest your money at a yearly return of 12%. And in further courses, we are going to be talking how you could do definitely 12% or even more than that. So this is the second table, which what I've done is it has the cash saved same way. And before doing the running total, I'm also calculating the interest amount. So first year you had saved 2,40,000. On that, 12% is about 28,000. Add that 28,000 to the total, and then you have the running total. Now the beauty is, at the end of your 30 years, you don't have those 5 crores, but what you have is 19 crores. Yes, that's right. It's 19 crores. If you really look at it, it's a huge difference from 5 crores. 5 crores was, I mean, 19 crores is 4 times 5 crores. And if you really look at it in little bit of granularity, by year 11, your interest amount is going to be higher than the expenses that you are going to be having year on year. Okay, that's the beauty of compounding. So after 11 years, your salary, whole of your salary, probably more than the whole of your salary, is going back into your investment, and your investments or the interest on your investment is going to be paying for your expenses, all your expenses. By year 18, what you see is your interest earning is going to be more than your yearly income, which is growing 10% every year. Even if you have a best of the best job with 10% increase every year, after 18 years, money you have saved, the small amount of money, not even 40% of your salary you're saving, and if you save that, that grows to a level where it earns you more interest than your income. So that's the beauty of compounding. And then at the end of 30 years, the amount of savings that you have with the cost of living, you are going to be able to last that for next 58 years. So let's say if you retire at 55, 50, you still have got enough money to survive for about 58 years, assuming the cost of living does not go up. If it goes up, it's gonna be reduced. So 58 could be 40 years. Maybe 40 years is good enough. I mean, life expectancy probably would be near about 100 years at that point in time. Same way, these 17 years may not be 17 years, it could be only 10 years. So in 10 years, you might actually run out of the cash. So that is the beauty of investing, compounding. And if you really look at it in a graphical format, the blue line is the first line that we saw, which goes to near about 5 crores, and the red line is the compounding thing, which goes near about 20 crores. This is the beauty. This is something that you have to, whatever happens, always remember, when you take loan, your loan is going to be growing like this. When you invest, your investments are going to grow like this. So whether you want to take loans, whether you want to do investments, your choice. Whether you want to have a safe, secured retirement, your choice. Nobody is going to get you that. Okay, let's move on. where to invest. If you really look at the mota moti, the big investment areas, these are the highest, most favored or used investment areas. First one is fixed income. You would be able to get FD returns not more than 6-7%. Now it could go up to 12% if you go a little risky. So fixed deposit is first one. Second one is government bonds. Again, then we have got semi-government bonds, the government companies which release bond. Then you have got corporate bonds. Corporate bonds is a place where you actually have the corporates who give you fixed return income bonds. But believe me, these bonds are as risky as anything else. If a particular corporate that is giving you the bond, and if that corporate fails to succeed, they can actually go bankrupt and not pay you a single penny. Okay, so please keep this in mind. Second one is the real estate. Real estate is a kind of a beast which takes a long time for you to understand, and it needs lot of investments to put your money into. And if you really need a single uh, rule of thumb, go for any investment real estate which gives you near about 5% of cost of that property as your rental. If that is what it is giving, you are getting into the right real estate. Even if you pay, let's say, 10% or 12% interest on that cost, it will surpass that by the point of view of the appreciation that it will get. And when I say 5%, I'm saying 5% on a monthly basis. Okay. Next one, sorry, 5% on an annual basis. Next one is the commodity. Most favored commodities are gold and silver. uh, these are actually not something which grow, but then the value of gold and value of silver is supported by lots of governments, and then they are also using that as a hedge. So you expect it to beat the inflation. It will give you 8 to 10% return, but it's better to have little bit of investment in gold and silver. And the last one is equity. Over the last about 25 odd years, we have seen the Indian equity market growing by more than 15%. You could expect, if you are very good in selection of stocks, you can expect up to 20, even 25% return on your equity portfolio. The graph down talks about how your distribution of the wealth should be. So what I'm saying is invest about 5 to 10% in gold and silver. It's always better to have non-risky, stable return assets. And then in the first few years of your life, maybe first 20, 30, 40 years of your career, you have no more than 10%, maximum 15% of the fixed income things, and remaining you put it in equity. You want to put it in mutual funds, your choice. You want to buy stocks, your choice. But then have something which is going to be uh, good return things, so that your 12% could be 15% and 20% and maybe 25% to get you freedom as early as possible. But at the time of retirement, around the time of retirement, please go ulta. Make sure that your fixed income return investments are up to 60, 65, 70%, and then you reduce your equity exposure, which is little bit of a risky asset. What that gives you is peace of mind. You don't need to really worry about what's going to happen tomorrow. You know how much you are going to be earning every month, every year, and you know how to spend that, how to enjoy your money in the later part of your life. Uh, that takes me to the general principles. Most of these I have already talked about. The most important thing is, believe me or not, risk and reward go hand in hand. There is nothing like I will give you 100% returns on your investments, 30% return, 40% returns. There are lots of software which claim that you will continuously keep on earning. There are a lot of people who claim that they have got hit ratios of 95, 100%. I am not sure. if they will be sustainable over a long period in time. Because if you are taking risks, only then you will get rewards. Yes, there are ways to reduce your risks while as getting good rewards, but then understand that you can reduce risks, you cannot eliminate them. The next one is when you invest into fixed assets, please be careful about the inflation amount numbers. If you invest, let's say, 7% return FD with in India, where you may have inflation of 8%, you're actually making loss of 1% every year. Please keep that in mind. And some of these bank FDs and other places, they also attract the income taxes that take away your returns. Real estate, I talked about, it has got little low liquidity. It's very difficult to find the right real estate, find the right price of the real estate. You require decent amount of capital to invest into it, and then there is a lot of paperwork, there are a lot of risks, inherent risks associated with real estate, because there is no standard governing body out there. Gold and silver, it's good. They help in calamities. They help at the time of war. Let's say something really drastic happens, and you are homeless. You don't have anything. One thing that will definitely help you is the gold that you may have, and you could trade that gold at that bad moment. It has got not very good returns, but it's good to have. That's one of the reasons why our ancestors, the last previous generations, always used to keep some little bit of gold with them. And then equity, it has got a capability of giving you high returns, and it has got moderate risks. In further chapters, we are going to be looking at how do we reduce risks and how do we increase the returns. So with that, I am at the end of this particular session. If you have liked it, please like it, talk to your friends, get them on board. We have a very nice platform here where we will be creating groups of people who are joining this course. You could interact with them. I'm sure there will be a lot of learning, cross learning, and there'll be we will enjoy the journey. Welcome to the journey one more time. Thanks a lot for being with me, and I'm sure you will get a lot more going forward. Thank you so much. Have a great time.